Cash accounting versus accrual accounting. It's a cruel joke sometimes to try to understand the difference, but let's get into it right now, right here. So let's get into cash accounting first. Cash accounting is a straightforward method where revenues and expenses are classified and are logged as they come in. They are recorded when the cash is received and when the expense is paid, or if it's a service, when the service is delivered. So cash accounting, first off, it is simple. It has simplicity in that it's very simple. Cash comes in, it's recorded. Cash goes out, it's recorded. The timing of it is also simple. So it's simplicity, it's got simple timing, and it's typically suitable for small businesses, sole proprietors, or anyone who's kind of in the early stages of their company. The pros, simple, easy to administer, easy to understand. The cons, well, it doesn't show the true financial health of a company because especially if you're getting into deferred payments or deferred cash receiving, now you're into booking a sale today. That might be the largest sale you've ever had, but only collecting in the future. Is that really indicative of how the company's doing? Perhaps not. Accrual accounting is a little more complex because it actually registers the income when they're earned or incurred, the expenses when they're incurred. So it's different. It's not when the money comes in or the money goes out. It's when it's earned. So the work done, income is earned, work owed, money is owed. So the characteristics of accrual accounting, first off, they adhere to the matching principle. So that concept in accounting, and again, I'm not an accountant, I'm giving you this general overview of cash and accrual accounting so that you're better able to read financial statements if you're looking at stocks or stock market. This is really in the purpose of how we use this to interpret what we see in the stock market on a daily basis. The matching principle is that the expenses should be matched to the revenue in the time period in which they attempted to earn that revenue. And obviously the timing is completely out of whack because it's when the revenue is earned and not received and when the expense is owed and not paid. So you might be paying a bill over the course of 2 years, but it was owed today. It shows up today as an accrual expense. Same with the revenue. So the pros, well, or the benefits of this, it provides a much more clear picture of financial stability, viability of a company. You understand more how management is managing. On the con side, it's more complex, more expensive, more difficult to maintain, and you can actually use it to obscure the cash flow situation a little bit if you're being manipulative. If you have an account or a firm that's being manipulative in how they report income and expenses, you could try to manipulate the numbers a little bit more on the accrual side. So there you go, guys. Those are the two ways to do it. Usually cash accounting, small businesses. Accrual accounting, typically above a certain number, or if you're a publicly traded company, you start to half. If you're a publicly traded company, most publicly traded companies, this is what they do. They do accrual method of accounting. Thanks for tuning in, guys. If you want to understand more about this or you'd like to book a no obligation consultation to chat about your portfolio, your stocks, what you own, your wealth, your retirement plan, go to speaktorob.com. We'd love to book that no obligation consultation, guys. Thanks for tuning in. We'll see you in the next video.